Hi everyone, Liam Bailey here from O'Brien Palmer. In response to the inquiries from a lot of our viewers, I've recognised expert in business valuation Stephen Groves to be with us today to answer some of your questions about valuing businesses as a going concern. Sale of businesses on the SME market is a recognised part of the restructuring landscape, and notwithstanding the focus on small business restructures, it's still important for us to recognise how businesses are valued. So accordingly, Stephen's with us today. Hi Stephen, how are you doing?
Liam, hello, nice to be here with you.
As I just mentioned, a lot of people have been asking us questions recently about how you go about valuing businesses, particularly the goodwill, and particularly businesses in the SME landscape where perhaps there might only be one director or one director and a small pool of staff as part of a business sale process. What have you got to say?
Look, absolutely. It's a really interesting area. I often get asked questions by clients who will say things like, Stephen, the business is all me. Without me, the business doesn't make any money. How can the business have any value? Or equally, Stephen, the business that I'm operating is having a really tough time. If you go back a couple of years ago, things were great, but nowadays things are really, really tough. How does that impact value? And it's a really interesting area. Valuation, particularly if there isn't any goodwill, that's certainly something that we see frequently, but sometimes there certainly is. Circumstances around what drives value in distressed businesses is always an interesting space, but getting directly to your point, when we're valuing, particularly from the perspective of market value, we're looking at how a willing vendor who's acting in a manager that's knowledgeable, prudent, and without compulsion would act in a market transaction. And from that perspective, we've got to assume that the vendor, being the business owner who we're acting for doing the valuation, if they were selling the business in the market, that they would want to try and sell the business for the highest possible price. That's what a rational vendor would do. And accordingly, we need to adopt logic that considers how somebody acting to maximise the price in the market would act and what that would mean so far as the valuation that we form an opinion of. And as part of that, let's say a business has customers that only have a relationship with a single person who's normally the director. We would assume that in a market transaction, that director would be incentivized to hand over those relationships. Equally, we would assume that a buyer would be skeptical around the handover of those relationships and would discount the price in consideration of any risks associated with those customer relationship handovers. So the short answer is it does impact value. It normally doesn't mean that value comes down to naught, but it does normally mean that value is reduced when those types of risks exist, particularly with small businesses and micro businesses where there might be a single person who operates the business who has all of the customer relationships.
I think that's a really important point you mentioned there, is what would a prudent person in the position of the director do? We have done plenty of videos in the past about pre-pack videos and how to ensure that we're not offending against the rules against Phoenix activity. At the same time, directors who are engaging in pre-pack business sales, which can definitely be in the interests of all stakeholders, are very concerned to ensure that the valuations that they receive are fair, to make sure that their transactions are upheld and not voidable, but also reasonable as part of a restructuring process to make sure that the restructuring process is actually worthwhile. So, if you form the view, Stephen, that a business's goodwill value is nominal or negligible in the context of the role that the director plays, how would you go about assessing the value of IP assets outside of the physical or tangible assets?
Look, it's a good question. I mean, really where we start when we're looking at IP assets is firstly, is there value there? Do the assets themselves, the IP assets themselves, directly or indirectly generate income? And would a market participant, being a purchaser in the market, actually have any interest in buying those assets? Oftentimes, particularly with smaller businesses, oftentimes the value becomes quite nominal for some of those IP assets. And I'm talking about things like, for example, a customer list or, for example, phone numbers. These are assets commonly that the business, particularly in the case of, say, phone numbers, assets that commonly the business won't have direct ownership over. They might be rented from a telephone company, for example. But a nominal value applied to those types of assets is normally sensible, particularly as well with respect to assets like domain names. Domain names, often we can look to the price that was paid for a domain name in the market when it was originally purchased by the subject business as a guide for a minimum base level value, and from there we can start to make consideration for if, for example, the domain name does drive income, whether there should be any additional value attributed to that domain name. These are all things that we can think about and look at, but generally, if the business itself is small and doesn't have strong financial performance, we generally see that intangibles beyond goodwill tend to have very nominal value or low value themselves. Most of the value in those types of businesses tends to sit with stock inventory and tangible assets. And often, the question that we're asking when we're assessing value is whether there should be any value over and above those tangible assets, and that value is really what we see in the form of intangible value, whether it's attributable to goodwill or another intangible asset, like, for example, a domain name or a customer list or phone numbers or the like.
The assets that most get questioned about usually have to do with things like the business's trading name, intellectual property such as logos, and websites. Now, there's a recognition that when people are trading with a business and a small business, they're usually trading with the director, notwithstanding the corporate structure in place, and that company name, that trading name, etc., is probably replaceable, and people will still continue working with the director. Nonetheless, directors are cautious about transferring trading names and websites because of the potential appearance of Phoenix activity. One way I know that's been suggested is the replacement cost. Can you tell us about that?
Yeah, absolutely. I mean, I think a replacement cost approach is very, very prudent, particularly if directors are looking to take a cautious and conservative approach around assessing value for intangible assets like, for example, websites and logos. The approach essentially is about identifying what cost a market participant would incur to develop a piece of IP of equivalent utility at a point in time. So it's not about developing the exact same piece of IP. That's not the case at all. It's about developing something that will form the same function, have the same utility as the subject IP. Accordingly, what often happens when we're going about assessing value of a piece of IP on a replacement cost method is we will look at what costs have been incurred for the subject asset. Particularly with, say, a website design, somebody might have spent $5,000, $10,000, $20,000 at developing a website. That's a good starting point for us. We'll then look and understand what costs were duplicated or redundant in the process of developing that website. So, for example, the business might have invested with one web design agency a few grand, decided that was a waste of time, that they weren't happy with their service, cancelled that contract and moved to another design agency who they went through and completed the project with. The few grand that they spent with the first agency, if that came to naught, that cost, of course, would not contribute to the replacement cost value. Thereafter, we get to a view of value based on essentially creation cost, and we discount back from that based on any obsolescence factors. So if, for example, the website was developed 5 years ago and it will be due for a renewal in another 5 years' time, a good rule of thumb might be to discount the total cost, creation cost, by 50% to account for the fact that the website is halfway through its useful life, to get to a view of what its replacement cost is now at this point in time, given its future value contribution to the business. So that's an overview as to how the replacement cost method works. And it's a really valid and sensible approach for valuing intangible assets. But importantly, a mistake is often made in confusing creation costs with replacement costs. They're actually very distinct things. Creation costs is often an input in calculating the replacement cost, but typically replacement cost is normally at a discount to creation costs. The actual costs incurred to create something often include redundant expenses. It's often not considered in those costs, for example, any economic obsolescence, any time obsolescence that might come through the period of time which the asset has been in place and might not be as useful nowadays as what it once was. So hope that's helpful.
Yeah, look, interestingly, when we look at the transfer of assets like that from the point of view of a liquidator, we might take a different view on the fact that if the business is effectively not really saleable to anybody other than the director, then similarly, the website is not likely to be able to be utilised by anybody other than the website as well. So the basis on which the valuation might be determined post a liquidation and pre-liquidation could therefore be incredibly different. But I think it's really important for directors and advisors to recognise that if you are looking at establishing a sale of a business as part of a pre-pack structure, it's important that you conservatively adopt the going concern value as if the liquidation wasn't a factor to give your transaction the best chances of being completely above reproach.
Absolutely. I mean, market value really is the primary standard of value that I think is relevant for doing any transactions on a sensible, conservative basis. I mean, when you look at the Australian Taxation Office's guide to valuations for tax purposes, the guide is really talking about market value. Most valuation guides really hold market value as the standard that should be looked at when valuing going concern assets, and I always think it's a good baseline to assess whenever looking at these types of transactions. Interestingly too, Liam, you're talking about in your view of things like websites and how typically the only sensible buyer for, say, a website would be the people associated with the subject business. I tend to agree, and I think those types of factors are absolutely relevant to assessing a sensible market value. Markets are really driven by supply and demand, and if there's a small number of buyers or hardly any buyers out there in the market, we ought to assume as valuers that a transaction can happen, but in doing so, we really need to consider those market impediments and how they would impact on value. And that's really part of our role and part of what we do when we're undertaking valuations of those types of assets.
Stephen, when it comes to objectively valuing assets such as plant, equipment, real estate, vehicles, whatever it might be, I'm assuming that that's a role that you bring external advice to the table as part of your valuation process?
Absolutely, Liam. There's no operators in the market that I'm aware of that specialise in all of those different areas. Most practitioners have a particular area of expertise, whether it's businesses and IP, whether it's real property, whether it's other tangible assets like plant and equipment. My view is absolutely to bring the right experts in for the right pieces of the puzzle. Interestingly though, sometimes it's not necessary for us to brief tangible asset valuers, for example, particularly when businesses have a reasonable level of profits and are not in a state of distress. We can normally have more confidence around our valuation approach without going and briefing tangible asset valuers, but certainly in distress scenarios, it's normally pretty prudent for us to brief tangible asset valuers separate to us to get a view of market value and also other bases of value as well to do with those assets.
Look, and then that brings us down to the last of the really common type assets that we see in business sale arrangements, and that's around the idea of debtors and work in progress. Now, I mean, I imagine that this is very different, whatever the business is and whatever industry is, but could you give us some general guides or principles about how debtors being transferred or uninvoiced work in progress being transferred can be valued?
Absolutely. I mean, work in progress and debtors are all part of the broader workflow cycle of a lot of businesses. Work in progress is work that's partially done that hasn't been invoiced yet. Debtors is work that's done and invoiced. That's essentially a nice, simple way of looking at it. From that perspective, debtors are really, really easy. Essentially, the approach to valuing debtors roughly should involve looking at what the debtor balance is and reviewing the debtors to understand if there's any bad debts or potentially bad debts and forming a view of an appropriate adjustment to account for any of those bad debts. It's a pretty simple process in that regard. So if there's $1 million worth of debtors and 10% are likely to go bad or to not be recoverable, a fair estimate of market value for those debtors is 900 grand. With work in progress, the question is, well, what level of work is actually recoverable on a billing basis? So it might be, you take a professional practice, it might be that there's $1 million worth of WIP. It might be that only 700 grand of that WIP can be invoiced. Taking up $1 million as the value of the WIP would be wrong in that scenario. The starting point is 700 grand, but then we also need to consider what level of that invoiced WIP will then not be collected during the debtor process. If the business has a bad debtor write-off on average of 10%, and we think that will apply to that WIP as well, then the $700,000 worth of invoiced WIP, when that gets WIP'd, when that gets invoiced, might get reduced down to 630 grand on account of the 10% deduction from debtors. Now, this is a really simple rudimentary view of how to get a rough idea as to what these WIP and debtor assets are worth. Importantly, particularly with extensive debtor ledgers and extensive WIP ledgers, often there can be a time value of money consideration that comes into this as well. So some businesses might have WIP that remains unbilled for significant periods of time. And we know as valuers that having $1 today is worth more than $1 tomorrow. So there can be a discounting factor in accordance that comes with not having cash collected quickly, but that's often not that relevant, particularly within short cash flow collection cycles and short WIP cycles of 30, 60, 90 days, which is common for most businesses. We don't see that as being a material factor that impacts value. It might have a very small, point of a percentage impact, but largely the approach I've suggested is really a good guide for people to look at. And it's certainly a material asset for many businesses, and something that really needs to be considered, and is often missed and misunderstood.